It's an urgent alert. I'm your host, Steve Metre, and thanks for joining me today. In our show today, Bank of America warns all customers to do this immediately, and I'll show you what the big bank is telling its clients they need to do right now and why they're making this suggestions. Plus, we'll put Bank of America to the test, and we'll review each and every recommendation to see if you should follow their advice, because this is our Sunday show, the show that makes you money, which is why we like to look at the technicals, momentum, and machine position in the markets each and every Sunday to help you make more money trading and investing. Now, let's head over to Bank of America where we take a look at the flow show to find out what Bank of America is telling its customers they need to do right now. And this is from their global research department, and they note that until investors need to buy bonds, well, they're not selling tech. And here's what they're looking at. Their private client group is currently allocated 62% to stocks, just under 20% to bonds, and about 11% to cash. But get this, the Magnificent Seven now represent 36% of their global wealth investment management clients' top 200 common stock exposure, suggesting that, as we know, investors are overweight 7 stocks in the market, and that is a huge risk to itself. But let's take a look at what Bank of America is suggesting its clients do as they look at a soft landing. Expectations are on the rise as consensus expects that any U.S. slowdown will be transitory as rate cuts work quickly and forcefully. Now, we know throughout history that that is not true. There is a long and variable lag to monetary policy, and that suggests that rate cuts will have minimal, if no, immediate impact on the markets. But that isn't stopping investors from actually trading on that belief. And they're saying sell the first rate cut for credit in stocks as hard landing probabilities are set to rise given the trajectory of the U.S. labor market, consumer spending, and capital spending, suggesting the 30-year Treasury best cyclical hedge for a hard landing, which is exactly the suggestion we've been looking at on our regular weekly show. These are all the issues that we're focused on, and Bank of America's got it right in their sights as well. They're saying to look for long assets with leverage such as REITs, but we're going to take a look at small caps and regional banks to see if you should be focusing on those. And how about long emerging markets? Well, that's what they're saying. Look at EEM and here's a surprise, long the Japanese yen. Now, this is a very risky trade, but we're going to look at that as well. And here you see again the long bond as B of A private client flows to Treasuries. Good window on investor and bond sentiment, where 80 billion to T-bills, 34 billion to notes, and only a mere 1 billion in bonds. And that is the evidence that Bank of America is suggesting. If you want some hard landing protection for your portfolio, look at where money isn't going. And right now, that is the long bond, because eventually it will change. And while many investors remain very bullish on gold, they actually are not bullish on treasuries. And what's notable, the relationship between the 10-year treasury real or inflation-adjusted rate, you're shown inverted in dark blue, against gold, suggests that if you like gold, you should be looking at bonds, because they are far deeper oversold compared to anything else. And if this chart is true, well, it means yields have a long way to come down. But how about the regional banks? Well, of course, B of A is saying relative to the large banks, this is the lowest in terms of the price relative to them, suggesting that rate cuts will be bullish for banks. But here's the risk, not in a hard landing scenario, but if there is indeed a soft landing, the regional banks could look very good here. And how about, of course, large cap growth, where Bank of America notes its clients are crammed into? Well, they're saying, look, you're looking at the equity market, you should look at small caps, since the growth as at its highest versus small cap value since the year 2000, suggesting opportunity will be in the smaller caps. But let's talk about what Goldman has to say, because all of a sudden they're changing their tune starting on the 17th of this month. That's just now 3 days away, as marked the local top for the month, heading into a materially lower August, and this is since 1928, suggesting there's going to be a summer equity correction. And if that's the case, then we'll take a look at Bank of America's recommendations, put them to the test, and see which ones you should be looking at. Let's start out with the S&P 500, as we like to look at that again, the technicals, momentum, and machine positioning. We note that machines are very long here across all providers, and we mimic that in our machine position report called CTA Timer Pro. This is a fast algorithm. This is a slow show one showing that the machines are long the market, of course, are signaling actually works ahead of the actual machines. Here we'll take a look. The relative strength index, this is at 72. We look at the technicals here. This is an overbought market. How about the MACD positive cross? Now many people struggle trading the technicals, so we aggregate them together, run a proprietary overlay. We call that Momentum Timer Pro. We have 48 consecutive daily buy signals on the S&P. On a 1 month window, it's maxed out to the long side. On a 3 month and 6 month, also maxed out on a momentum perspective. What we see here, upside target, we don't know because investors are chasing this top higher. Downside target now is at 532.09. But when we look at the charts, we really don't see any red flags here, at least in the immediate future. Now, if you're wondering what this purple line is, well, I'll show you that in a minute. That is a small cap market, but let's take a look at, of course, the S&P 500. It continues to grind higher, but Goldman's warning that in a couple of days, well, that means the top is in. But let's take a look at Bank of America's perspective, because if we zoom out far enough, you'll note here there is a relationship between small caps, again shown in purple, and large caps. What they're saying is people are going to look for opportunities in the U.S. equity market as they buy into the soft landing scenario. And we have been warning over the last couple of weeks that either small caps need to rally, which they started to do, or the large caps need to come down. This time Bank of America is saying, look, if you want to be long the equity market, look at small caps. They're likely to play catch up to those large cap equities. Now let's take a look at tech stocks here. But before we do that, you might be wondering, how do we make money with all this information we're showing you? As of the close of Friday, our machine position report called CTA Timer Pro, we had 12 open trades to our subscribers. All 12 of them were up. Could you imagine trading and seeing a win rate like that? It's virtually unheard of. And if you like to trade the technicals, well, we do that too. Going into Friday close, we had 21 open trades, 19 of them are up. That's a 90% win rate. Here's the deal. You get the report, you get the signals I'm showing you, you get my opinion, I tell you which trades to take, I give you the stop loss levels for those trades. We even track the trades and the returns on them, and every Saturday we update the stop loss levels. And here's the best part. You want to make money trading? We have a 30-day free trial. Links are in the description below. We make it that easy. You take the information that we teach you and you put it to use, make money. And yes, that is your opportunity only for a 30-day free trial, and you can start making money right now. Let's take a look at the tech stocks. What do we see? The relative strength index is 65 again, and a signal here of an overbought market looking for a correction. MACD's got a positive cross. We look at Momentum Timer Pro again, 48 consecutive daily buy signals. So the market here is stretched, and now on a 1, 3, and 6 month period, what do we see? Tech stocks, they are maxed out in terms of their momentum signals. This thing is a deeply long market that is ripe for a reversal. Does that mean it's going to happen tomorrow? Not necessarily, but at some point what we know is that when everybody's piled in one direction, the markets tend to go the other. Let's take a look here at the QQQs, and what do we see? Of course, a market that is very stretched in this valuations. We're going to find out more as we hit earnings season, but keep this in mind. With the economy slowing, this might be the last quarter of good earnings before we start to hear companies suggest that what we're noting and what Bank of America is warning about, that we might see a hard landing scenario. So that puts, of course, the next earnings season as, of course, downside expectations. So the rest of the market here is long, but what do we note? The Bank of America says, look, if you want to be long the equity market, go into small caps. And sure enough, we have, for our subscribers, we're not long small caps, but we made another trade in the mid caps just a matter of days ago. It's up a bunch already, and small caps have followed suit. And what do we know? Momentum is positive, relative strength index at 47. So you see a market here, it's just building in momentum, and the MACD's got a positive cross. We'll take a look at those here in a moment. 6 consecutive daily buy signals across the 1, 3, and 6 month. We note that momentum is at a lower level, showing a minimum signal here, potentially building momentum to the upside. We're now putting an upside target much higher. Look at Friday's closing is 200. Our upside target now 227. Downside target is, of course, that is a mistake. I made an error there, as you can clearly see, but let's take a look at what the actual charts say, because something did not get updated before we went live, and there it is. Closing value is 213. We're taking upside target 227, downside target right in the 207 range. And what you're seeing here, this was a supply zone right above here, and this is where sellers have been at. And every time it got in this zone, the sellers have showed up and pushed prices down, which is why we started to make the case that equity market was going to move down as small caps were leader here. But now, on the hope of a rate cut, small caps jumped, suggesting their next move is up here toward this upper end of the supply zone. And that means, of course, big opportunity. Let's take a look as we zoom in here to the 6-month window. We see now, of course, relative strength index. It is fairly high. And of course, the momentum on the MACD is building here, suggesting there is still potential opportunity in small caps if the soft landing scenario is actually valid. But let's take a look at the banking sector. We see momentum positive, relative strength index. That's up there at 70. MACD's got a positive cross as well. Everybody came in and bought on the rate cut and drove stocks higher. We see 14 consecutive daily buy signals. You know, we don't have position on this. This is Bank of America's recommendation. Friday's closing at just under 49. Upside target based on what we're seeing on the charts, just under 53. Downside target at 46. And we'll note machine positioning here is already long, and momentum is fairly long. You see a mid-sized momentum across the 1, 3, and 6 month, suggesting that maybe there is limited upside to this trade. Let's take a further look here at KBE, and what do we see? A big move higher here. And what's notable is it jumped right into the supply zone above, and you see it's right here where the sellers have been at. If we go back to say 2022, what do you see? Selling, further selling into 2023. There were even sellers before, of course. We saw regional banks just collapse going into, of course, the March banking crisis. This time, everyone says the small banks look okay. The question you should have right now is, will the sellers show up? If they do, look for those sellers to drive price right down to that red line here that was shown in the support zone, because that is where the buyers have been at, and you want to see that. We'll zoom back out here. You can see the volume support right at the lower end of that purple line. So what you want to look for if price gets rejected here, buyers to push price back down, and that would be where you'd want to take the opportunity. Because remember, right now, this is an oversold market. Momentum's building here. And don't be surprised if going into trading early next week, we see people starting to cash in on their positions. But what about emerging markets? We note the Bank of America says there's opportunity there as well. We see momentum is positive, but again, this is an oversold. You see the market here, RSI is at 76. This is oversold. Positive cross on the MACD, suggesting that maybe the play here, according to Bank of America, is to look for a pullback in these positions before going long on them. That might be a more prudent move. You know, we have no position here. 18 consecutive daily buy signals. Now, we do have, of course, foreign exposure to our subscribers. We're just not in EEM at the moment. Price closing at 44. We're seeing it upside targets at 46.49. But again, momentum here is fairly stretched. The machine positioning is max long, and we just find that there's better opportunities. We like to show our subscribers how to buy low when things are deeply oversold and machine positioning is massively negative, and take advantage from there, not buy high and hope it goes higher. Let's take a look at the chart here of EEM before we talk about the bond market, that is. And here we see EEM. What we can note is looking at the 6-month volume profiles, buyers stepped in here, drove the stock higher, but let's zoom out to the 5-year window because we need to, and we'll see here it's getting right into an area of resistance where sellers previously were happy to sell. This was happening back in early 2022. A breakout of that suggests upside target right around 46.49. That is the next level of resistance. So possible breakout here, but keep in mind when you look at the technical side, this thing is massively oversold on the relative strength index. The last time it got up here, what happened? It rolled over, created an opportunity. You'll notice it held a 50-day moving average here in green. You want to know how to trade moving averages? You wait for a cross and then a confirmation. If you see a pullback to EEM on that 50-day moving average, or down here around 42.32, there is your opportunity to take a chance and look for some upside play. Let's talk about the bond market, because what we note is Bank of America says this is the big opportunity. If you're looking to hedge your portfolio against a hard landing, what we note is Hartnett from B of A said this is where you want to be because nobody else is there. And of course, where no one else is, that is where the biggest opportunities lie. Momentum is actually positive now. We see 2 consecutive daily buy signals, as I did not update the slide there properly. Relative strength index at 57 and building. Positive cross on the MACD. And for our subscribers, on July 9th, we added a position in TLT. Now, you may wonder, we don't have a stop loss here because this is one of those where we're trading without a stop loss on it, which we don't recommend our subscribers do. We want to show you in case that happens and the market moves in the wrong direction, you want to dollar cost average your way back in using the signals, and based on that, right now we're down 0.06%. Many people say there's no way you'll recover this, but there you see it. Cost basis 94, Friday's closing just 6 cents below that. Now suggesting the upside target is at 94.89, downside target at 100-day moving average. And look at this. Why did we put that trade in? Because the machine positioning pulled back, and that was the signal we gave to our subscribers. Let's take a look at the TLT here, and yes, that is just how easy we make it. We give our subscribers all the information. We tell them which trades they should do, and we tell them where to put their stop loss levels. That is pretty incredible, and our track record, as you see, is impressive. Let's look back to the 1-year chart here, because what we can note is that sellers were driving price down, and every time it came up and tagged this dotted purple line, sellers were happy to sell at lower and lower levels until things got oversold. Buyers started to push in here, and what happened is they drove price up, and they're looking to push those sellers out, but the sellers came back in a major way, drove price right back down, touched that dotted purple line. Buyers came in and said, now the bulls are taking charge, drove price right up into the 1-year volume profile. If it breaks out from here, you've got short sellers all the way up this dotted purple line. They'll get worked out. It's putting our initial target just above here, but all the way up into this $100 price range. We can look at the technicals. What do we see? Of course, momentum building, not at oversold territory yet, and we just got a positive cross on the MACD, suggesting that Hartnett, this may be his best call of his report, is the long bond, not just on a hard landing hedge, but on the upside potential of a Fed rate cut coming in September. As we know, when the Fed cuts once, well, they cut a whole lot more than that. So that puts the upside to the bond market. Now let's talk about gold, because back on June 21st, not only did we give our subscribers the signals, I give you my take when I see something on the charts. Here you can see what we told them back on the 21st of last month. And what do we know? That trade up 2.42%. And is it that easy? Yes, it actually is. Momentum's positive on gold. We see the relative strength index not at overbought territory, but potentially getting near there. MACD's got a positive cross. We revised our stop loss, and yes, we give these to our subscribers, 221.28, because Friday's closes at 223. We want to always try to lock in gains where we have them. Upside target unchanged from last week at 225.10, downside target at 215. We note the machine positioning here is long gold. This makes a lot of sense. Everybody is very bullish gold, and we see a trend here in momentum is building on the daily. And let's take a look at a chart of gold. As what we can note is this thing is striking distance of its all-time high here, and that means, of course, investors likely to push that further higher. As it goes up, we want to raise our stop loss levels because we've seen rejection up at these levels. Maybe it breaks out. We've seen that happen before, where I was wrong and thought, of course, a triple top meant, of course, gold was going to head lower. It broke out. We're seeing this happen again, but anytime you're making money, you want to lock that in. And what do you see here? Momentum building on the MACD from oversold territory. Of course, the RSI leading that. It's not at overbought territory, but momentum moving in a nice direction. We'll see where this heads into next week. But remember, when you have money in your pocket, try to lock it in. On the 21st, we also had a signal on GDX. And a note, we're still holding a position on GDXJ. Right now, that trade is up 3.76%. We got 8 consecutive daily buy signals. We raised the stop loss level to 35.56. Got again. Key here, hold on to gains. Friday's closing at 38.17. If gold goes higher, this is going to potentially shoot up a lot more. Relative strength index over bought at 71. MACD's got a positive cross. Everybody is long this. You look at the machines are long. You look at momentum is fairly long, except for a recent short-term pullback. But let's take a look at GDX here. And what do we see is nothing but potential opportunity for those who bought in earlier. And now you see there's that pullback, and now it's taking off. We had our subscribers buying in right around the 21st near this short-term bottom. If this breaks out, what you're looking at is a move up here into almost $40, if you can imagine that. Let's continue on because we've got the dollar and the yen. Dollar here now reversing. We, of course, put a trade on at UDN. You remember that? And it went the wrong direction. Many people said, you got the dollar wrong. Well, that dollar wrong is now up 1.33%. We think the dollar further weakens here, particularly as investors trade on a cut from the Federal Reserve. But let's take a look at the yen. This is a very speculative trade, and this did show up on our reports, and I warned our subscribers repeatedly, trade it if you want, but this is something I would pass on, and I'm going to show you why on the charts. Let's first take a look. We see the relative strength index is 58. Momentum's building here. MACD's got a positive cross. You know, no position. Again, we advise our clients, our subscribers, that is, do not take a position here, even though we see a shift in technicals and machine positioning, and there is a good reason why we did not want that to happen. Is because the issue is speculators have been coming in and shorting the yen every time it takes off here, and you can see every move higher, every threat by the Bank of Japan, the price jumps, sellers come in. Price jumps, sellers come in. Price jumps, you want to take a guess if sellers are coming in. Here's one simple way. You know the 50-day moving average in green until the price crosses it with a solid conviction and holds. I would wait on this one just from a perspective that I do not think the Bank of Japan holds onto this trade. Instead, I think the speculators are back here very quickly into next week. But now you can see how we show people every Sunday to make money trading. Again, links in the description for all our reports and that 30-day free trial. And as always, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.